Constellation Software. If you haven't heard of this company, it's one of Canada's crown jewels. Actually, it might be one of Canada's all-time best performing stocks along with Shopify. The bottom line is that year by year, this is a company that keeps ticking up. It's so consistent, and people that have invested in Constellation for many years almost expect a 20 to 30% return from the stock every year at this point. And so as a result, this company is seen by many in the investing community as a compounder. That word gets thrown around a lot, and maybe I'm a little bit of a hater, but a lot of people use that word for any type of stock that just has a chart that looks like this over the long term, without any consideration for the moat, the durability of the business model, and any other type of fundamental. And so the result is that when you see something happen, a catalyst that drops the stock like this, and that has happened to other companies this year, like Pfizer, for example. A video is coming on that one, so stay tuned to this channel. When you get a big drop like this in a compounder, you get people that automatically buy the dip. My goal in this video is to give you a balanced view of Constellation Software as a business, because there's not a lot of creators out there that actually take an objective view of this business and that focus on the risks. When you look at other videos on YouTube about Constellation, you'll see a lot of people just focusing on the financials, like the PE ratio, the return on invested capital, very superficial things. Either that or they'll just have a biased opinion and a very subjective opinion about the stock being just a super great pick. So once again, maybe in this video I will sound like I'm a hater of Constellation Software. That is absolutely not the case. I just want to give you a view of all the major risks, and we're going to be covering all of them. There's three big ones that I can see. Because at the end of the day, investing isn't just buying into quality companies. It's not even buying into quality companies at decent prices. Because guess what? The investment universe is huge. There are thousands of companies out there. And there will always be more than one place that you can put your money, more than one quality company selling for a fair price. So being a good investor is about managing this opportunity cost. Not just finding a good opportunity, a average opportunity, but finding the best opportunity for your money at this given time. And so just a quick plug before we begin. This is Rated A, the platform that I have created for this purpose. The whole point is to give ratings for companies, but not just any rating. A qualitative rating for how good of a quality this company is. That way we can identify, before anything happens to the stock price, which companies we want to own in our long-term portfolio. And then the value rating tells you how good that opportunity is right now. The value rating is what I use for my own investments, the Rated A portfolio. So far, we're killing the market in 2025. This chart says we're up 27% year to date as of November versus the S&P's 17%, but this chart gets updated once a month. The next update will come next week on the first day of December, and this difference with the S&P 500 has risen even more. I also track the performance of the quality ratings themselves. So far, it's looking a bit all over the place. As you can see, the quality ratings of B are still outperforming the A's. Actually, the F's are doing the best overall. But the theory is that as more and more companies get added to the database and as more time passes, the sample size will increase and these numbers will start to reflect the reality that overall, A's perform better than B's, perform better than C's, then D's, and then F's. The higher the quality of the company, the better the long-term performance. But back to Constellation Software, this company is suffering the worst drawdown in its history. Whenever a high-quality company falls from grace like this, and the stock appears to be on discount, your job as an investor is to try to figure out if this is market sentiment shifting or if something has fundamentally changed with the business model. There are three main issues that I was able to spot with this business for why this stock might have sold down so much and so quickly. But before we go into that, I think it's important to do a little review as to what Constellation actually does. If you do a little bit of research into Constellation, you'll see that it's basically a holding company and it owns thousands of VMS businesses. VMS stands for Vertical Market Software, and it's basically a software tool that takes care of all the needs of one specific little niche business. The reason why you're seeing a library on the screen right now is because that's the type of software that Constellation owns. For example, the software in libraries where they manage books and inventory and stuff like that. Other types of small niches include chicken coops, gyms, prisons, basically anything that's very niche, very specific, and that big tech doesn't really have an incentive to go into because the market is too small. As you may very well be aware, AI is becoming very powerful, and it's becoming a possibility to, with just a prompt, a chat prompt in normal English language, to very quickly create a functioning software business. If I type in Google AI tools to create software easily, I get four options right away. Base 44, I've seen ads for this one. Claude, Bubble, ChatGPT's got one. And I'm aware of many other companies that do this for their clients. And if you play around with one of these tools like I did with Base 44, you'll quickly come to the conclusion that this industry is on the verge of something really big. The software that is produced in just a few minutes by these companies, it's not perfect, but it's really good for the amount of prompt and the amount of effort that you put in. And if these are the tools available to us in 2025, what is going to be in 2030, 2035? One of the very obvious things in life, one of the things we can count on as investors is that AI will get better, technology will improve, and usually in an exponential manner, not linearly. So these big new technologies will arrive to us a lot quicker than we imagine. And so obviously this is a big issue for Constellation because at the end of the day, Constellation's clients are very small niche businesses. And the software to manage a library, for example, is not very complex. You need one, two, maybe three features. That's the first type of software that will be displaced by these new companies like Base 44. And if it's this easy to create a new software, then what's stopping Constellation's clients from building their own software and bypassing the fees, the monthly subscription fees that they pay to Constellation's VMS businesses? That is the main question for Constellation right now. There is one main counter argument, and it's that the businesses that Constellation serves are not very tech savvy. If you work in a library, if you work in a gym or a prison, you are maybe not even going to be able to create that. You don't have the skills, you don't have the patience, maybe. And so you're always going to want a professional to help you out, a consultant or someone from Constellation to serve that solution exactly to your needs. And at the end of the day, these non tech people are happy with the software that they currently have. They're not always searching for new and better solutions. They've been used to Constellation software, there's inertia there, so most likely they'll stick to Constellation. And this risk isn't particular to Constellation. A lot of well known software businesses are also selling off on this risk. And I can name a few off the tip of my tongue. Adobe is one, Salesforce is another, and ServiceNow is a third. Those are the big three software businesses that have been selling off due to this AI risk. Ultimately, there's just lots of uncertainty around AI and how it will reshape the software space. It would be foolish for me to stand here and say that I know exactly how this will turn out. The point is, nobody knows. And so, before you jump into Constellation, you need to think for yourself what you think the outcome would be and factor that into the price when you buy Constellation or not. The next key risk has to do with Mark Leonard, the longtime founder and CEO of Constellation. It seems that this is the only photo of him that's available on the entire internet. But this guy has been with Constellation since the beginning. He's the one that has created this acquisition machine this well-oiled acquisition machine. He sets the hurdle rates, he sets the entire system in place, and at the end of the day, he's the reason why Constellation has been so successful all these years. For the first time, Constellation will have to operate without him being the leader. Because, yes, he left the spot a few weeks ago due to health concerns. And this is a classic example of key man risk because nobody knows how the company will be able to manage without him. Will they stick to the hurdle rates? Will the system keep functioning? At first, my intuition says yes, because of the way Constellation is structured with their different operating groups. It's a very decentralized business. So, Mark Leonard has set up the system in a way that maybe he doesn't even need to be managing it and be a part of it for it to work. But let me just give you an example. This is the shareholder letter that Mark Leonard wrote to investors in 2021, so just 4 years ago. He starts the letter by saying, "One of our directors has been calling me irresponsible for years. His thesis goes like this: CSI can invest capital more effectively than the vast majority of CSI's shareholders. Hence, we should stop paying dividends and invest all of the cash that we produce, even if it means lowering our hurdle rates." I used to argue that we need to maintain our hurdle rates because dropping them for a few marginal capital deployments would cause the returns on our entire portfolio to drop. The evidence supported my contention, so we kept the rates high for small and mid-sized vertical market software acquisitions. The byproduct of that discipline has been a perennial inability to invest all of the cash that we generate. So in this letter, he is clearly saying that he's already having internal arguments with some of his directors about the best way to proceed, and he has been able to convince them, of course. Having these types of discussions with the people you work with in a company like Constellation is super healthy. I'm not saying that that's the problem. What I'm trying to point out is the fact that now Mark Leonard is not here. And so, what if in future discussions, the conclusion is that yes, all the capital should be deployed even at lower hurdle rates just to grow the business a bit faster? These are the types of things that we cannot know. The third and final big risk I see for Constellation software is not one that I see that's talked about online very much. And that risk has to do with the business model. If we look at Constellation's revenue growth, I have rarely seen a revenue growth chart that looks this perfect, but it's the way that Constellation has been growing these revenues that could become problematic in the future. The reality is that a lot of this revenue growth comes from acquisitions, so it's inorganic growth. And so far, that hasn't been a problem at all. As long as management can keep finding good acquisition targets, and as long as management is able to use the profitable cash flow from those targets to buy more targets, then everything keeps going round. The company is famous for having a very high hurdle rate of 20%, so any acquisition that gets done, you can be sure that the return will be there. And they take that hurdle rate very seriously. I've seen reports that if they expect the return to be 19.9%, they dismiss that acquisition target. The problem is that there's not an infinite amount of VMS businesses in this world. And actually, the success of Constellation software has been noticed by other companies that have imitated the same business model and have started acquiring VMS businesses. The result is that there is a shrinking pool of VMS businesses. And what that means for Constellation is that in the future, there will come a day when they will have a choice. And they will have three options. The first option is to just do nothing. Stop acquiring, close the M&A shop, keep the businesses that they do own that are profitable, collect the cash flows, and redistribute to shareholders via dividends or share buybacks. But that wouldn't be enough to get a 20 to 30% return yearly as a Constellation shareholder. So that's not an ideal scenario. Scenario 2 is to keep buying VMS businesses, but just move up the food chain. So stop acquiring bigger businesses. And the problem with that is that now you get to a place where there's more competition, because now it might be worth it for bigger software, big tech companies to actually compete with you. And so automatically, with more competition, the hurdle rate would go down. So now just to keep growing, you are expecting a lower return on the cash flow you use. Option number three is to just ditch the VMS and start acquiring smaller businesses of a different type. And that would have a very similar outcome to option number two, because at the end of the day, software is very profitable. And so if Constellation started acquiring non VMS businesses, then the margins would go down. And at the end of the day, the hurdle rate would go down. So it's almost a catch 22. You can't grow forever. Usually, size is a source of moat. It gives you scale, it gives you cost advantages. But for Constellation, it's the opposite. Being a bigger size actually hinders the returns that this company can get. Once again, this is not an existential risk for Constellation shareholders today, but it's something to keep in mind if you're planning on buying the stock or just adding to it after this drawdown. Because, like I said in the intro, it's all about the opportunity cost. And while Constellation might give you a return of 15, 14, maybe 13%, could you find a business that gives you a better return than that? If yes, then it might not be the best decision to buy Constellation in the first place. Before we finish this video, I'm going to do a quick valuation calculator because Constellation is still a high quality company. It's rated as a B in the Rated A database, but the value rating is a 51, which means it's not quite the best buy you can make right now. Let me just show you. If I put the current price of the stock, which is 3,400 Canadian dollars, the current revenue, and I imply a 20% revenue growth rate for the next 5 years. And by the way, that number sounds huge, but it's what Constellation has been able to do forever, pretty much. Actually, I went back to the revenue growth rates, and yes, they have managed more than 20% in the last 3-4 years, but there have been years where it's been all the way down to like 13-14%. So I'm going to be conservative and put 17% revenue growth for the next 5 years. Margins of 20%. They don't do any buybacks, so I'm keeping shares the same. Multiple of 26, a dividend growth rate of 5% with all dividends reinvested, and we get a total shareholder return of 12% per year for the next 5 years. You can always play around with numbers and increase the multiple to 30, which is what Constellation has been historically. They've even been higher than that. And if you do put the multiple at 30, then we get a much higher return of 15%. At that point, it would be a good buy. I like to be more conservative because what if any of the risks that I talk in this video come to be? It's not unlikely that the multiple could be trading at 20, which is still a pretty high number. And then the return would be just 6.5% for the next 5 years. So everything depends on your assumptions. What do you think Constellation will be able to achieve in the next 5 years? And do you think right now is a good time to buy? Please let me know in the comments below. That's it for this video, and I'll see you in the next one.